Everyone wants AI exposure, so they chase GPUs, buy the headline names, stack their portfolio with anything that moves when NVIDIA sneezes. But here's the problem. The real money isn't made by owning what everyone else is buying. It's made by owning what everyone else depends on, but no one else is paying attention to. There's a company that doesn't make chips, doesn't build data centers, and doesn't sell AI models. But without it, none of that works. No chips get built, no hardware ships, no AI runs. And right now, it's trading under the radar with 80% recurring revenue, billion-dollar backlogs, and margins that software companies would kill for. The crazy part, most investors know the name, but they have no idea how important it actually is. Let's get one thing straight. This company doesn't make chips. It doesn't fabricate silicone. It doesn't run foundries. It doesn't ship hardware. What it does is own the workflows that every major chip maker on Earth depends on, and they've been doing it for over 30 years. They're not riding a trend. They built the track. This company builds the software that designs the chips before they ever hit production. The EDA stack, electronic design automation, is what turns architecture into reality. It's how NVIDIA engineers design H100s, how Apple prototypes silicone, how Google builds TPUs. And Cadence, ticker symbol CDNS, is locked into the center of all of it. They're not some speculative AI play. They're an S&P 500 company with 80% recurring revenue and the kind of client relationships that most businesses would kill for. But here's the wild part. Most investors still don't understand what they actually do. They just added 50 plus new customers to their Cerebras AI platform in 1 quarter. Cerebras has already powered over 1,000 chip tape-outs, meaning real physical silicone designed using their AI. Their tools are so critical that ripping them out would cost customers millions and delay products by months. This isn't hype, this isn't potential, this is real infrastructure. And while the market drools over GPU headlines, Cadence gets paid every time one is built, no matter who builds it. The takeaway, Cadence isn't a chip maker, it's the bottleneck every chip maker has to pass through. And in the AI arms race, being the bottleneck is the most profitable position you can be in. Cadence doesn't act like a chip stock. It doesn't behave like a software stock either. It's both and neither. What you're looking at is a company with the financial engine of a SaaS business bolted onto the upside of a semiconductor cycle with a product so sticky it's practically unreplaceable. Let's run the numbers, and this isn't theory. This is Q1 printed and confirmed. Gross margin 88.4%. Operating margin 41.7%, and that's the non-GAAP operating margin. The free cash flow $464 million just last quarter. Revenue up 17% year over year and accelerating. EPS up 34% year over year. Those aren't startup multiples, those are industry-leading execution metrics, and they're climbing. Most chip makers would kill for these margins. Most software companies would kill for this backlog. And here's what makes it dangerous. Cadence doesn't just sell one-time licenses. It locks in multi-year contracts with global chip makers, foundries, and even hyperscalers. It's not optional spending. It's infrastructure spending, which is why 80% of their revenue is recurring and gross retention is through the roof. You're looking at a business that can grow 10 to 15% a year without needing the broader market to cooperate. It's not cyclical noise, it's contractual cash flow. That's why they bought back $350 million worth of shares just this quarter, because they know what they've built, and they know Wall Street doesn't fully appreciate it yet. The takeaway, these are elite financials in a misunderstood vertical. It's not a hype story, it's a cash flow machine, and it's just getting started. So here's the real question. Is this business getting stronger every quarter? Yes. Are the numbers trending up across customers, contracts, revenue, and cash flow? Yes. Is the product becoming harder to compete with? Absolutely. Now let's prove it. In Q1, Cadence delivered $1.01 billion in revenue, up 17% year over year. $464 million in free cash flow, up 43% year over year, $6.4 billion in total backlog, which is an all-time high, and 80% recurring revenue, plus they raised full-year guidance across the board. They're not hoping AI demand shows up. They're booking it in advance. They're not chasing customers. They're closing multi-year renewals with Fortune 100 chip makers because this software is deeply embedded in billion-dollar schedules. What you're seeing is operating leverage in action. Every quarter, the business throws off more cash without bloating headcount. Margins are scaling, not just sustaining. And while other companies whine about macro uncertainty, Cadence is out there stacking growth from hardware, from IP, from systems, and from AI workflows, all in parallel. It's not one segment firing, it's the entire engine clicking into place. The takeaway, if you're still wondering whether this is a good company, you're asking the wrong question. The only question now is whether the price reflects how fast this thing is compounding, and based on market behavior, it doesn't. Now, every great business has a blind spot. Here's Cadence's, China. Last year, 11% of their revenue came from China. This year, management is modeling zero. Not reduced, not lower, zero. And here's the part nobody's talking about. Despite planning for a full write-off of that region, Cadence still raised their full-year guidance. Revenue is up, margins are up, earnings are up, even while slicing off a billion-dollar segment of the business. That's not normal. That's real power. But don't let that distract you from the reality. This is a geopolitical time bomb. Because this isn't about product failure. It's not about competition. It's about U.S. export restrictions tightening and Cadence's core software being labeled critical national security infrastructure. That puts them in the blast zone of every future sanction. If Washington pulls tighter on EDA exports, if Beijing responds with retaliation, or if a major customer shifts development away from U.S. tools to avoid scrutiny, that 11% doesn't just disappear, it sends a message to the market. The stock is exposed. Now, to be clear, the business is still strong, the core cash flow engine is intact, but this is the one narrative risk that could drag the stock down regardless of their fundamentals. The takeaway, if this risk explodes, the story breaks. It's that simple. I'm not avoiding the stock, but I am pricing in the landmine. And if you're not doing that, you're not investing, you're gambling. And this is exactly why I show you the full picture, not just the upside. I cover the risks so you actually understand what you're buying. I'm not here to pump stocks. I'm here to help you see the potential, the pitfalls, and the truth. Let's stop guessing. You want to know if Cadence is a long-term buy. Let's look at both sides and cut through the noise. First, we've got the bull case. This is one of the most efficient business models in tech. Most investors are still sleeping on it. We're talking the 80% recurring revenue, gross margins near 90%, and operating margins very high at 40%. This isn't hype, it's a machine. They've got long-term contracts across NVIDIA, Apple, AMD, and Intel. Their software is so critical, it's now classified as national security infrastructure. That's not me hyping it, that's U.S. export policy confirming it. Cadence doesn't need to win the AI race. It just needs everyone else to keep building. Revenue is projected to grow from $4.3 billion today to $6.1 billion by 2027. EPS is forecasted to climb from $5.97 in 2024 to $10.55 by 2029. That's without any heroics, just execution. And here's the kicker. As AI design complexity increases, Cadence becomes more essential because they own the tools, and the tools are what scale. So now the bear case. There are two real risks, China and valuation. China was 11% of revenue in 2023. Management is now modeling that to zero. It's not a guess, they're planning for it. That's the smart move. But geopolitics do not care about guidance. If headlines heat up, the stock could react regardless of fundamentals. Then there's valuation. You're paying 77 times earnings. That's expensive. If growth slows or margins slip, that multiple compresses fast. So here's the bottom line. This isn't a trade. It's a business with compounding earnings, a bulletproof moat, and a geopolitical shadow hanging over the stock. If you want momentum, look elsewhere. But if you want to own the tools that AI depends on, and you can handle the noise, this is a long-term asset worth watching very closely. Now let's address the elephant in the room. The stock is flat over the last year. It's actually down 0.83% to be exact. And if you're asking, why should I buy a stock that hasn't moved in 12 months? Good, you're thinking like an investor. Here's the truth. The market got distracted. The business didn't. Cadence has stacked stronger numbers every quarter. Revenue, EPS, cash flow, backlog, all up. Meanwhile, the stock has done almost nothing. That disconnect is exactly what creates opportunity. You're not chasing a parabolic run. You're stepping into strength that hasn't been priced in yet. Technically, the chart is clear. $295 is hard support, tested and respected multiple times. Every bounce off that level has followed through. On the upside, $326 is your resistance. That's the breakout trigger. A close above it, I'd expect momentum to flood back in. So what am I doing? I'm not going all in. I'm not swinging for the fences. I'm looking to build a position slowly and only on pullbacks or strong technical setups. The fundamentals are clear, the technicals are tight, the setup is clean. And here's the real question. Is this business getting stronger every quarter? Yes. Are the numbers trending up across customers, contracts, revenue, and cash flow? Again, yes. Is the product becoming harder to compete with? Absolutely. That's what we want to bet on. Not noise, not hype, the real fundamentals. So at this point, you've got two options. Option one, you do nothing. You keep watching videos, you keep reacting to headlines, you keep letting the market push you around. And option two, you get serious. You stop playing defense. You start executing with clarity. You use what I just showed you, not someday, but right now. And here's my account. I'm up over 34%, which is $1.2 million this year, and we're only halfway through 2025. And that's even after my biggest position, Palantir, dropped more than 9% on Friday. That's not luck, that's a repeatable process. Here's what my community is doing. They're stacking 20, 30, and 50% gains, sometimes in days. Not once, not randomly. They're following the system, they're following the strategy. This isn't a slot machine, this isn't a guess. It's a framework built around fundamentals, technicals, and execution. So if you want to see exactly what I'm buying, when I'm buying it, and how I'm layering in options for weekly returns, join my Patreon. Inside, I give you real-time trade alerts, daily breakdowns of what's moving and why, the exact strategies I use to pull cash flow out of this market. So you can keep guessing or you can start compounding. But either way, don't say you weren't told.